So what we're going to talk about today, you've probably never really heard of, and it's actually called the McGinley Dynamic Indicator. And actually, you know what? It's a close cousin to just your standard moving average that pretty much all of you are familiar with. And unlike the moving average, right, from your simple moving averages to your EMAs, your WMAs, doesn't matter. This indicator, the McGinley Dynamic, actually adjusts automatically according to the speed of the market, which is kind of cool. And before we get started, make sure you subscribe down below, hit like, and at the end of this video, if you have any questions, make sure you pop them in the comments. Now, we all know that the standard moving average is going to lag, especially when the markets are moving quickly. Well, the McGinley helps to mitigate that issue. So the lag with a standard moving average can be shorter or longer. It just depends on the period that you're using. Now, the McGinley, it's often described by people as the most reliable trading indicator you've never heard of. Well, whether that's true or not, it's really going to depend on your take about the reliability of indicators to begin with. So let's talk about where it came from. The guy's name was John McGinley. He invented it because he wanted a more responsive indicator than just what a normal moving average is. Now, we know markets tend to not move in a constant rhythm, right? As momentum steps in, it drives price, then it disappears, and you get price goes into a range. And while you can adjust the look back period on a moving average to account for these changes, well, that brings up another issue of whipsaw and the price separation using the average. So as an example, a 10-period moving average is more volatile than a 50-period moving average. The 10-period is closer to price, and often it's inside the price, while the 50 can have a wide gap between itself and price when momentum comes in the market or gaps in price. Well, the McGinley takes this into account. It takes the shifts in the market speed, and it will plot a smoother and a bit more responsive line. So this can actually cut down on the number of false trading signals if you use an indicator for trade entry decisions. In this example here, I set the blue line to the exact same setting as the McGinley indicator. So the calculation of the indicator, I'm not going to get into that. It's a lot of math going on with that. Just understand that that calculation allows it to speed up and close the gap with price. Okay, we also see how it slows down and it appears to support price while the blue moving average just cuts right through it. So the lag, it's not totally disappeared, right? But the key point is the indicator is more reactive than the short and the longer term moving average. So McGinley's goal was to have this indicator hug price action. That would reduce the huge gaps between the indicator and price, as well as that snake effect as the average wraps through price. So how do you use it? Well, first we learned three things. It adjusts to changing market speed. It can reduce whipsaw and reduces indicator lag. Now, putting on your chart, it's simple. You just apply it like you would any other moving average. You also have to select the look back period. And the rule of thumb for that is use half of what your standard moving average setting would be. So if you use a 50 period, that'd be 25. If you use a 20 period, it'd be 10. So in this chart here, I'm just going to mimic the 20 period moving average. So the McGinley is now set to 10. So right away, you can see that the McGinley is a lot smoother even when we use a lower setting. So keep in mind that you're going to adjust the period of the McGinley depending on the type of trader that you are. So if you're a swing trader, you may use a higher setting such as 25. Well, a day trader may use a setting of 5. A common use of a moving average is for a quick decision on the trend direction. So if we're looking for an uptrend, we want to see price move above it and then stay above it. Okay, so this will put us in buy mode or look to exit any short positions that you may have. In a downtrending market, we want to see price break below the indicator and remain there. That puts us in shorting mode. This is no different than any other moving average. I would also ensure, though, that price is making a higher high for an uptrend or a lower low for a downtrend. So Using price action along with a trading indicator is, in my opinion, one of the best ways to use a trading indicator. Okay, I would not simply just use a cross of the line as a signal. All right, so which strategy would you use? Well, we can see that it helps determine trend, but the question should always be, how are you going to actually trade with it? Now, it's really easy to throw on other indicators. Okay, but I come from the less is more school of trading. So is there a way that we can use the McGinley without tossing on the MACD, the RSI, or just a normal moving average? Yeah, sure. Use it as a guide. I made a video a while ago about using the daily chart for a trading strategy. So let's see if we can improve on that by using the features that come with the McGinley. So this here is a daily stock chart, and the setting I'm using is the 10 period MDI, which is the McGinley. The trading rule is very simple. For longs, we want to see two lows completely above the indicator. For shorts, just reverse that. We want to see two highs completely below the indicator. We're going to buy stop above the highest of those two candles at 20% of the 5-period ATR. You're going to place your stop loss 20% of the 5-period ATR below the indicator. And we're going to trail our stop on the line at 20% ATR from the line. Let's zoom in on this first trade so we can just understand what I just said a little bit better here. At number one, we have two lows completely above the average. Okay, they're not touching the average. We place a buy stop at the highest high of those two. Okay, a stop is then placed 20% times the 5-period ATR below the indicator. Just going to trail our stop until we get stopped out. That actually ran for $29 a share before he got stopped out. So let's break it down even more. Okay, we're going to have some more detail here. So the candles on the left, they do not meet the criteria for a short trade. Why? Because there are not two highs completely below the average. So let's take a look at our first trade. Our first trade is long at $74.02. And how do we get that? Well, we take the high of the candle, right? That is $73.51. 20% of the 5-period ATR at this point in time is 51 cents. So our entry price is the high of the candle, that's 70.31, plus 51 cents, which we got from the ATR calculation. So our entry price is $74.02. Our stop is set at $69.80. How do we get that? We take 20% of the 5-period ATR, it's 51 cents. At this point in time, the MDI reading is $70.31. 70.31 minus 51 cents equals $69.80 stop loss. That's actually a nice first trade win. Is you trade your stop loss up 20% ATR from the MDI. The green asterisk, that's a potential short, but it doesn't trigger before price closes back above the line. And finally on the left, this trade would have triggered a few days after the setup and you'd still be short. So the question is really, should you use it? Well, if you're using a moving average anyways, I would test this out with the strategy that you're currently using. I like the smoothness of it personally, and I think it does fit in nicely with the trading strategy I just talked about. Should you add another indicator? No, not really. I think I'd experiment with playing pullbacks and reversals from the line before deciding to add another derivative price to the chart, right, which is a trading indicator. You can also check out the video on trading bull flags, along with using the MDI for trend determination. Anyways, any questions, put them below. I'll get back to you on those. Again, make sure you check out that daily chart trading video. Will help you more with this strategy. Thanks for watching. Hey, subscribe, like this video, and we'll talk to you soon.